What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, we are recapping the Delta Airlines double calendar strategy play. And as you can see by the portfolio, at the time the market just opened up, we did, in fact, make some good money. So if you're excited for today's video, as always, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. So at the time of recording this video, market has just opened up. We have closed the Delta positions, and as you can see, we are up 2.4% already on the day, which is absolutely awesome. We're going to pull up Delta Airlines here, and they have a great earnings report. So what we're going to be looking at here is that they released their earnings. And again, the idea behind this strategy here is what is called a double calendar. Basically, the idea behind the double calendar strategy that we have been running now, this is now the second trade doing it. We did it with Nike for their earnings. We made a crap ton of money with Nike. Delta Airlines, we didn't make nearly as much money, but we still were able to profit. And I'll break down the numbers in just a moment. So what we're looking at is we have a 2-strike price double calendar play. And the idea behind it is that you are to sell shorter dated options and let theta decay kick in, take some profits before earnings comes up. The goal here is to take those short options, which is these options here, and close them before earnings. The reason why is because just in case we get some huge movement in the stock, you are at risk of early assignment. Now, this is considered selling naked options at just selling these two here. So selling this option and this option is naked options. So what we do is we buy a call option, we buy a put option to count as our collateral. Instead of having the cash or the shares, we can then just buy the 100 shares worth in the put option or the call option as a result. But the difference is, as you'll see, same strike price, but the expiration dates are a week apart. This one is closing tomorrow, which their earnings were today. This one is closing next week. Now, the reason why the double calendar here is working to my favor is because the hope behind it is that even if we get volatility crush, where there's no movement in Delta Airlines, for example, the value will be lost here, but not completely, which is what we definitely want to have as a result. So what we're looking at here, again, is a 4-leg option here. Same strike price on the call side, same on the put side, but just a week apart, one before or one at the earnings week and one afterwards. And the goal that I do here, the strategy behind it, is to take these short options, so this one for the 11th and this one for the 11th, and to close them before earnings to avoid assignment. And what you'll notice is that those two were, in fact, closed out. And the profits, I believe, for these ones here, again, when you're selling options, you buy to close and you sell to open, okay? So you buy to close these because these were sold to open here. So we bought these and bought them back and closed the options out. Now, what you will see, and I'll put it on the screen here for a reference, is that this option right here, this Delta put that we bought back for a whopping $18 per contract, and we had 3 contracts. This one pulled in $30. No, the other one was $30. Sorry, my apologies. I have it written down here. This one pulled in $180 worth of profit. This bought call option, the bought to close one, this one brought in only $30 of profit. So between these short legs here and here, we made $210. Now, when we closed out the 2 short legs before earnings, what that does is it leaves us with the long legs. And the long legs are what are bought options. And the idea behind it is that they create what's called a straddle. Okay. The straddle basically is saying, hey, I'm looking for Delta Airlines to move in either direction based off of the earnings report. And the significant move in either direction is where you would make your money as a result. So what you will see is I just closed these out about 12 minutes ago or so, and the market, and it kind of, I didn't like the pre-market action price here for Delta Airlines. I had a little bit of a sell-off going into the market open. So I just kind of took my profits off the table, called it a day. Nothing wrong with that one. It is rebounding at the time of watching this, but who knows? Maybe it could have came down more. I'm not really quite sure. But So for the call options, since Delta Airlines did shoot up quite a bit as a result, the Delta Airlines profit that we made was $345 in profit here. And then we closed the put ones for a whopping $279 loss. So we'll break down the profits and the losses here overall, and the returns, again, not as good as Nike earnings did, which is fine though. But again, as you can see, Delta Airlines did have a good earnings report. And again, the implied move is about 6 or 7% or so. I was kind of just hoping for like a 4-ish to 5% move up. So everything else after that is profit. And again, as you can see, would have made a little bit more money here. But, we take profits with this kind of challenge and this kind of trading strategy. We're taking profits. And now here is the breakdown of the trades here. And I'll show you the Nike one as well. So what you will see on the spreadsheet here is we broke down the Nike stock, the Delta Airlines. I have two open right now, American Express and Charles Schwab, which I opened those ones up last week. These ones have earnings pre-market Friday morning, which again is a really good time to do it. I look to have their strike or their expiration date and earnings be very, very close together because you can maximize that decay. Like if they had earnings on like Tuesday, there's still 3 more days of decay or any kind of volatility to move in that case for the short legs. So I try to pick stocks that have earnings either Thursday pre-market, Thursday aftermarket, Friday pre-market. Those are the ones we're looking for here. And Charles Schwab and American Express have both of theirs on the 18th pre-market, which is a Friday, which is good. So and taking a look here, again, I write down the strike prices, the put side and the call side, how much it costs per contract. Again, because they're selling options here and buying options, they kind of offset each other just a little bit. And the idea behind it is to have the short legs make some profit to then offset the cost of the straddle that you go into earnings with. With Nike options here, again, we paid $112 here. We realized $332 of profit on the short legs, which is about 46.6%. It's almost half of that one. Because what happens when you get closer to earnings is that they don't lose as much volume, as much value, because you have those implied volatilities expansion happening. So I closed these the day of. I closed the Delta ones, I believe, Tuesday, the time I'm recording this. So we took actually a little bit more profit on the Delta Airlines compared to the Nike one for the short legs. Now, we have the max loss as a result because, again, when you close the short legs off, you are left with those 2 bought side options there, and that's going to maximize your loss as a result still. So it is something to keep in mind about as we know. Here's me taking my profits for the long ones because Nike had a killer earnings play. And so this plus this gives me a grand total of $1,128 in profit from the trades. What I like to do, though, is subtract the total cost to open it. So this price minus this one gives me my total profit. So the Nike earnings one was 900%. I'm scroll over a little bit. 900% return on Nike. Delta, we didn't do as well. Should I have closed it early? Probably not. But again, I want to take my profits when I can. And as you will see here, we got a 45.55 here, $35 per contract, 3 contracts worth. We closed in for almost 50% profit on the short side, which is great. Love that, taking that. And again, the reason behind it is because this profit of $210 kind of offsets the max loss on the long legs, which is very, very nice as well. We closed the long positions this morning, as you know, for a profit of $66. But $66 on the long legs plus the $210 from the short legs gives me $276 in profit from the entire position. So open to close. Take away how much we paid for it, which was $105, gives us a total of $171. Now, even though that is not nearly as good as the Nike earnings, which definitely is expected. You're not always going to get those Nike earnings reports as 12-13% here. The nice thing is we took $105 and we came out on top of that with $171. So we still made, yes, we had $266 as a result to show for it, but pure profit was $171, which is a percent return of 163%. I don't know about you, but making 163% on my money in a matter of 2 weeks is an unbelievable return. Thank you guys so much for watching today's video. If you've made this far in the video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications so you can take a look at these kind of trading strategies here. Hope you're making money in the market in some way, shape, or form. And as always, I will see you guys in the next video.